So today we're going to be talking about the bank run on Silicon Valley Bank, and then also another bank run, as well as the fear of possible contagion from these bank runs and how it could have actually affected the entire banking sector. This could have been really bad, and fortunately it wasn't. So, without any further ado, we may as well just go ahead and get started on this. This is going to be a fairly lengthy lecture here, possibly, I don't know. So, what are we going to be talking about? Well, we're going to talk about Silicon Valley Bank. We're going to talk about how and why they collapsed. Namely, what could they have done to avoid it? And then what wasn't done that could have been done to avoid it? What also is it, you get into what could have happened, right? Like what they could have done to try to fix things or really prevent things from happening in the first place. You get past that because, basically it's already been done, right? You can't put the shit back in the goose. So what next? Well, what could have happened after the run and then eventual collapse of Silicon Valley Bank, right? Because it didn't just end there, right? All these guys are very heavily interconnected, so it's like if you knock one out, the others could potentially go as well. So what could have happened? And then also, what did happen? And then that kind of leads into the question of what role does, or I guess did, the federal government play in this crisis, namely when it comes to trying to actually remove us from the crisis. But there are also arguments that were made that I'm not sure they have a ton of merit, but there were also arguments made regarding federal deregulation on certain banks that Silicon Valley sort of fell within the umbrella of those banks, namely the asset sizes, and then their exemption from various stress testing, CCAR scenarios, all that stuff. So we're going to get into what the government did, what the government could have done, what the government should have done, all that fun stuff. And then we're going to ask at the end of this, are we safe from it, right? Is this something that we don't really need to worry about anymore? Is it something that was contained? Is it indicative of a larger problem? Well, that's for, I guess, future us to decide. But we're going to talk about it a little bit. So, what was Silicon Valley Bank? Well, it was a state-chartered commercial bank. They started it in 1983, and the idea was to try to fund tech company startups in the Silicon Valley area. Now, what I mean by the bank being state-chartered is that it was subject to state regulators rather than federal regulators. But the idea here for the bank, right, the reason it was started in the first place was to provide loans to a lot of these tech companies that are trying to get started in the Silicon Valley area that ultimately need the capital to be able to do it. Now, when you start a company, it's not like you're like, oh, hey, you know what? I started the company today, and then tomorrow I start generating and reporting revenue. It doesn't always work that way. Sometimes it takes time. And with these tech companies, it can definitely take some time because, you got to rent the land space. You got to hire people to do this stuff. This isn't just something that you're like, okay, well, we're started a company. I borrowed the money. Now I can start paying it back immediately. It may take time to be able to do that. So Silicon Valley Bank would structure their loans in such a way that these guys didn't have to just start paying back immediately, right? They could pay back a little bit later. So how are they going to fund that, right? Because the bank makes loans, but that's only like one side of the bank. What about the other side? How are they getting the money to be able to lend out all that stuff to fund these projects? Well, they were going to have to collect deposits. So they were collecting deposits from venture capital firms. And then they also eventually expanded into financing some other venture capital firms as well. I don't know why I'm having a hard time saying that. Whatever. Now, that's all fine and dandy. Because the bank eventually became pretty big. It became so big, in fact, that when it failed in March of 2023, it was the second largest bank failure in U.S. history, and it was the largest bank failure since the financial crisis of 2007 and 2008. So you can see when Silicon Valley Bank went under, a lot of people got really scared because they were like, this could be ugly. So, well, let's get a little bit further into this stuff. All right, so the bank's deposits, well, they increased quite a bit after March 2020, after the pandemic. These deposits increased from $62 billion in March of 2020 to $124 billion by March of 2021. Now, what was the bank doing with these deposits, right? They were, because you want to lend some out, but you also need to make sure that you're not just lending out all this money. Because if you do that, well, there's a high risk of default. You could, end up in a situation where you can't be paid back, and then all of a sudden you got these depositors going, hey, where the hell's our money? And you're like, oops, sorry, lent it all out, didn't get it back, too bad. You don't want to end up in that situation. So what are you going to do? Well, you're going to also want to make some fairly safe investments to essentially try to diversify your loans, your portfolio. Diversify your assets, not your loans. Diversify your assets. So what they did was they bought a lot of long-term treasury bonds. Now, you could be like, hey, that's not a bad idea, but there are these long-term bonds. They've got a higher return than the short-term bonds, but it's also because you're lending it out for more, so you're going to be getting a lot more in interest back if you lend money out and you buy a bond for, say, 10 years instead of 1 or 2 years, right? So it's generally a pretty low-risk investment strategy, but it's only a low-risk investment strategy if you don't have any intention of selling them off before maturity. Now, the market value of these bonds fell dramatically in 2022 because the Fed started to raise interest rates, because the Fed had rates extremely low. They'd had them at or near zero since March of 2020 when the pandemic hit. So when they're doing that, you've got this massive expansionary monetary policy effort going on, and rates are extremely low. And that is when the bank bought a lot of these long-term treasury bonds. So let's say it's 2021. You see inflation ticking up, and there's a lot of talk in the market that, inflation's high. What's the only thing that can be done to try to tamp down inflation? Well, eventually you're going to have to raise rates. This is the first thing that they did wrong that they should have seen coming. Because if you have low rates and high inflation, that's generally a good sign that sometime in the relatively near future, at least the not too distant future, you're going to see an increase in interest rates. Now, what does that mean for bonds? Well, bond prices and interest rates on those bonds are inversely related. So if you have a bond and the interest rate goes up, now this is a bond that's already been sold by the Treasury, right? You bought the bond, you're holding on to the bond, and now you want to sell it on the secondary market. Well, if the interest rate on the bond goes up, or the interest rate on other bonds goes up, right? Because the interest rate on your bond is fixed. The interest rate on other bonds is going up, and you've got this bond at a lower interest rate. Well, nobody's going to want to buy it because the return's going to be a lot lower, right? So what's the only thing you can do? Well, you can drop the price on that bond and get somebody to buy the bond at a discount, because that's the only way they would actually be incentivized to want to buy that bond from you rather than a higher interest rate bond from somebody else. So if the rates were to increase, then the bond prices would fall. Now, it's not necessarily a big deal if you don't plan on selling these bonds. If you just buy the bonds and you sit on them, okay, yeah, you could have gotten a little bit more if you had bought a bond later on, but it's not like you're losing anything if you just sit on the bond and let it mature, because then you get the principal back plus all the interest that you've gotten. So not like a super huge deal so long as you don't plan on selling these bonds. But by the end of 2022, the bank had a $117 billion bond portfolio. $91 billion was supposed to be held to maturity, and this wasn't marked to market, and profits wouldn't be realized until they matured. Now, the remaining $26 billion was available for sale, right? So 91 of that $117 billion they were planning on holding to maturity. Those are like the long-term treasuries that they were holding. Now, 26 of that 117 was actually available for sale. Now, you can see that they're holding a lot that they expect to be able to hold for a long time. And they're not holding very much that they're like, well, in case of a rainy day, we can sell this stuff. But it's not all that much, especially, compared to the overall size of their bond portfolio. And by the end of 2022, the mark-to-market unrealized losses for securities held to maturity exceeded $15 billion. What does that mean? Well, what that means is that because of the increased interest rates, the bond prices, should they have to sell any of those long-term bonds on the market, those bond prices were essentially falling. So you buy an asset, right? Let's say you buy an asset for $100, and then the value of that asset drops from $100 to $85, right? Well, if you don't sell it, that's an unrealized loss, right? You've lost $15. Essentially, that's what's happening here. So what was going on is the bank didn't hedge against interest rate risk. Now, a lot of banks will hedge against interest rate risk by holding short-term bonds as well. And these guys didn't really do that. Instead, they were like, we're just going to hold a lot of long-term bonds. Well, again, not a bad plan so long as you don't find yourself in a situation where you have to sell those bonds because, well, they mature, you get your money back, as I've said, probably ad nauseum at this point. So really, the way that they were invested was very, very, very bad. They were very poorly invested here, and they didn't see something coming that they probably should have seen coming, especially considering that this bank started in 1983, right? They'd been through all sorts of booms and busts in the business cycle, and they've seen just how much the tech industry can move around. So if most banks hedge against this interest rate risk, why didn't Silicon Valley Bank? Well, this is where it just goes from like, you guys could have done better to what the F were you guys thinking? Their chief risk officer stepped down in April of 2022. Hey, that happens, right? People leave jobs. It's life. You get over it. But what you don't do is when somebody steps down, you don't go, well, we're just not going to fill this position for like 8 or 9 months. That's dumb, especially the chief risk officer. That's about the dumbest thing you could possibly do. It's a very important position at the bank because the entire organization underneath the chief risk officer is the organization that considers the risks that the bank faces. I've worked under risk, probably about 2.5 years, maybe 3. I had worked under risk, and 2.5 years. I had worked under the risk, like the chief risk officer. I'd worked in that organization, and essentially anything that has to do with potential losses that the bank faces, stuff that we would have had to deal with. And then we go, all right, these are the potential losses. How are we going to avoid these losses? How do we make sure that, if, say, for example, GDP drops, the United States goes into a recession, how do we weather that? All right, how is the bank's financial position going to change based on us going into a recession, interest rates going up, GDP going down, stuff like that? But the person overseeing all of that just wasn't there. There wasn't a chief risk officer for like 9 months. So basically the person who's supposed to be monitoring all this, who's supposed to be looking at all of this stuff, just wasn't there. So it was really dumb, especially considering that between April and January, April 22 to January 2023, there were a lot of interest rate hikes, like huge interest rate hikes, trying to get inflation tamped down. when you have those massive interest rate hikes, well, you are sort of by default exposed to a massive amount of interest rate risk. This bank is being exposed to more and more risk, and the person that's overseeing this just isn't there. Right? They didn't. That position just wasn't backfilled at all, which is just it was dumb to the point of like maybe the bank deserved to go under for being that stupid. Because the high interest rates aren't just going to affect the market value of the bond holdings, right? Because those were unrealized losses. The loss isn't technically incurred unless you sell them on the secondary market. And that's where, as I was saying, if the interest rate goes up, right, the interest rate on just the bond market, interest rates go up, you're holding a lower interest rate bond, well, you're going to have to sell that bond at a discount to get anybody to want to actually buy that bond rather than another bond that has a higher yield. But again, those are just unrealized losses. No loss if you don't sell it. But these high interest rates aren't just going to affect your bond holdings. It also affects the borrowing costs that other companies face throughout the entire economy. It's not even just in the tech sector, right? It's everywhere. So what happened is there were other depositors at Silicon Valley Bank that started pulling out money to be able to meet their liquidity needs. Because if you're like, okay, we want to expand X, Y, and Z, well, interest rates are going up. Maybe we don't want to borrow it. We do have the cash on hand, so maybe we can just use that instead. Not to mention, with inflation going up, well, eventually you're going to need more money to buy the same number of goods. So you get these depositors pulling out money to meet their liquidity needs. So all of a sudden, the amount of deposits that Silicon Valley Bank has much lower. Well, what are they going to do? Because Silicon Valley Bank still has their own liquidity needs, right? And all the deposits that they had started drying up. What are they going to do? Well, they've got to be able to raise cash to meet their liquidity needs. What do you do then? Well, you have to sell some of the assets that you have on hand. On March 8th, they sold $21 billion of securities, and they borrowed an additional $15 billion, and they held an emergency sale of some of its treasuries to try to raise another $2.25 billion. Now, let's say you're a depositor at a bank, and they start selling billions and billions and billions of dollars of their assets, trying to raise funds to maintain the required liquidity for that bank. What are you going to do? Because I can tell you what I would do. I would panic like you would not believe. And that's exactly what happened. Right? This announcement goes out. Investors start giving warnings, and the depositors get really scared. They get worried about a possible bank run. And as we talked about in the previous lecture, when it came to bank runs, right, if there's a bank run, if there's any possibility of a bank run, right, like even just a rumor, people can get spooked, and it's entirely rational to go out and try to withdraw your money, even though you know that it's a lie. So depositors run to the bank. They try to pull out all their funds. They pulled out $42 billion. Well, yep, classic bank run situation right here. Now, when they try to pull all this money out and the bank doesn't have the money, that's when you get to a really big problem. So on March 10th, the California Department of Financial Protection and Innovation seized Silicon Valley Bank, and they placed it under the receivership of the FDIC. Now remember, the FDIC covers the depositors within a bank up to $250,000 per person per account. But nearly 90% of depositors exceeded this amount. All right, so if you've got $20 million in the bank, and the FDIC is like, well, we'll cover $250,000, you're going to be really pissed because you're like, that's almost just an insult to me based on how much I just lost. So there's a big problem there. Now, 2 days later, the Treasury gave the FDIC the authority to make all depositors whole, So basically, even if you had $20 million deposited in that account, and the FDIC is supposed to cover you up to $250,000, now they got the authority from the Treasury to cover you for all $20 million. Now, you do it this time. This is where people start going, oh, there's a bank bailout. Well, not really. This wasn't really a bank bailout, because the bailout is designed to rescue the bank. This wasn't designed to rescue the bank. This was designed to make the depositors whole. All right, this wasn't the depositors need to get their money back, and we're going to keep the bank afloat by lending money or just flat out giving them money, etc. It wasn't that. All right, the bank was still allowed to go under. It's just that the depositors weren't allowed to go under. Now, the shareholders of the bank, right, people holding stock, they weren't rescued. The management of the bank, well, they all lost their jobs, as well they should have. So this isn't necessarily a bailout. This just made sure that if you deposited money with the bank, you weren't screwed. Now, you could kind of get into some of the moral hazard concerns around that, which we talked about in the previous lecture, right? With, there's a possibility of moral hazard if basically, the government is going to come in, or some insurance entity is going to insure these deposits, while the bank's going to be a little bit riskier, right? So, there are some moral hazard implications with this. But overall, do I think it was the right thing? In all likelihood, yes. So let's wrap up what we got so far. Silicon Valley Bank made some kind of dumb investment decisions. They invested in long-term Treasury securities, and they were bought when rates were low, even though everybody knew that at some point rates were going to go up. So they could have been a little bit wiser with what they were doing. Now, when the Fed raised interest rates, bond prices fall, and all of a sudden, the market value of the bonds they were holding, should they ever need to be resold, fell dramatically. Pretty dumb. Very, very, very dumb. And then depositors got spooked because Silicon Valley Bank went, we need to raise some cash because all of a sudden our deposits are drying up. Other depositors get really scared. They rush to the bank. You get a bank run. The bank can't fund all those withdrawal demands. The bank becomes illiquid, and eventually it becomes insolvent. And then the FDIC has to step in and insure depositors. Now, the bank should have been better positioned to withstand the higher interest rate environment. They should have seen it coming, right? You can't forecast everything, but there are some things that you just go, yeah, that makes sense. This is one of those, especially if you are an economist, especially a macroeconomist. This is something that you're like, okay, high inflation, low interest rates. Well, Fed can really only control inflation one way, and that's via interest rates. So if inflation's high, they're going to go, we need to raise rates to try to curb inflation. It's stuff that just should have been common sense. However, the bank didn't have a chief risk officer, which was just stupid beyond measure. So, thus far, are there things that could have been done to prevent this? Absolutely. It's not to say that, this never would have happened. It's not to say that some depositors wouldn't have tried to pull out just because, interest rates are increasing and the cost of borrowing, it gets higher, it disrupts business operations. Like that stuff you can't necessarily control for. An individual bank can't control for that. They can't stop that from happening. But what they can try to do is they can try to prevent a run on their bank by, being invested a little bit more wisely. But again, these are things that people working under a chief risk officer would deliver up the line to the chief risk officer, who can then make, some of the big decisions, which in this case it appears just weren't being made. Sadly, it didn't stop here. Signature Bank also went under not long after. Because on March 10th, after Silicon Valley Bank's collapse, the depositors at Signature Bank in New York got scared, and you had another bank run. They got scared for a slightly different reason. because Signature was exposed a lot to the crypto sector, and there were a lot of uninsured deposits. So if you've got an uninsured deposit with a bank, and there's a possibility of collapse, well, you're going to get really spooked, right? You're just going to like immediately run to the bank and try to pull it all out. And Signature Bank had a lot of uninsured deposits. In fact, only 10% of their deposits were actually insured. And only 5% of the bank's assets were in cash. And if you compare that to the industry average, it's about 13%. So, I mean, they were, what, like a third of what the industry average was? A little over a third. So ultimately, both banks got seized, and they were turned into bridge banks until someone would come along and buy them. Now, what's a bridge bank? Well, a bridge bank is essentially... Sorry about that. I had a cat jump on my lap. So a bridge bank, what is a bridge bank? Well, it is a bank that gets created by a regulator that essentially is meant to operate a failed bank until somebody can buy them. All right, so basically it serves as like a bridge between when the bank failed and when somebody can take the bank's assets and absorb them. Now, Flagstar Bank bought out Signature Bank. That happened relatively quickly, actually. But despite that, right, despite the Signature Bank being bought out, investors and regulators started to get really scared that there was a contagion of this bank run, because if it keeps happening, well, the entire U.S. banking sector could collapse. I mean, that would be really bad. And on March 13th, other regional banks started seeing their stock prices fall, and a lot of people started pulling their deposits out. Western Alliance Bank, their stock lost 70% of its value, and this one actually hit pretty close to home because I worked with Western Alliance Bank for a while. Really great guys there. First Republic Bank lost nearly 75% of its value, and this was like before 12 o'clock on March 13th. I mean, it was scary. It was really scary stuff because people start panicking. They start wondering, okay, you know, we had two banks go under, and now we're seeing a bunch of other smaller regional banks start to go under. And this is around the time the Treasury granted the FDIC the special exception to guarantee the uninsured deposits for both of the failed banks. So if whether your deposit is insured or uninsured, well, it's now guaranteed, which of course leads even further into that moral hazard discussion we were talking about, because it sort of becomes like if you go to a casino and I give you $10,000 to gamble, it's basically me going, here's $10,000, whatever you win, you keep, whatever you lose, I refund up to $10,000. So if you go in to gamble and you know, regardless of what you do, you're going to walk away at the end of the day with at least $10,000, you're going to do some really stupid shit, right? Much stupider than if, say, I gave you $10,000 and I said, whatever you lose, whatever you win, you keep, right? The risk-taking behavior that we would see would be drastically different between those two scenarios. Now, on March 26th, right, like 2 weeks later, the FDIC announces that First Citizens Bank shares would be acquiring Silicon Valley Bank, with all the depositors at Silicon Valley Bank now becoming depositors at First Citizens. All right, so if you had money deposited there, well, it would carry over to the new bank. So then the question is like, all right, well, you know, if you're a depositor and, you know, basically it's what you got at this bank just sort of is going to carry over to the other bank, why would you need to be made whole by the FDIC, right? I mean, it's a valid question. Like, you know, if you can't access your funds today, I mean, that sucks. But, you know, if, like, say, a week or 2 weeks later, you will be able to access the funds. I mean, yeah, it's going to suck for those 2 weeks, but I mean, you'll be able to get it, right? So why would there be any need whatsoever to have somebody come in and make whole all of those deposits for you? Well, the reason is this. In that interim, there were a lot of companies that couldn't make payroll. Even though the depositors would eventually be made whole, they still had to worry about like the next few days, not a week or two down the road. A lot of startups had to take out loans just to be able to pay their workers because of California law. In California, I think it's like a week or 2 weeks or something like that. You can't go very long without paying your workers. So you can't be like, well, look, we can't make payroll, but we'll give you everything plus whatever else you earned in the next pay period. It doesn't work that way in California, right? So if these companies can't access their money, they'd have to furlough their workers. Or they may even have to shut down entirely because of that law that really puts a constraint on your behavior. So if this bank is doing stupid things and they essentially gamble money away, and then you can't access the money that you deposited with that bank, you now have to shut down your company entirely. That's an awful situation to find yourself in. And then it turned out there were a lot of companies that had cash reserves at Silicon Valley Bank. Roku, about a quarter of their cash reserves were held there. Vox and BuzzFeed also had a lot of cash concentrated there. I mean, let's be honest, nobody would have missed them if they went under. But there were also like affordable housing projects that were delayed, and the effects are actually expected to last for like months and months and months after all of this stuff. So this isn't something that like, well, just sit tight, you'll get your money later. This is stuff like we need the money now and we're not getting it now, and because we're not getting it now, we could go out of business. I mean, could you imagine what would happen if like, half of all the like mom and pop shops in California went under just because they couldn't pay their workers? I mean, that would be like just like all out mayhem. These are things that we can't have happen. So when it comes to some of these depositors being made whole by the FDIC, I get it. Honestly, I really do. But even then, some of these guys still had to take out loans just to be able to pay their workers like, within the next couple of days. So it was an entirely screwed up situation. Now, what happened in the financial sector? Well, the market capitalization of U.S. banks lost about $100 billion in 2 days, and European banks lost about $50 billion. And some companies, like I had said with Western Alliance and First Republic, all right, some companies that were banking with them got really worried about their ability to remain liquid and solvent, and they transferred their deposits to other larger banks. Hence, this is why you saw the fall in Western Alliance and First Republic stock, losing 75% of its value. Now, Silicon Valley Bank's situation was pretty unique in terms of who it lent to, because it was lending to a lot of tech startups, and they can be extremely risky. All right, so you're lending to a very risky sector of the economy. And now, as we've seen, the tech industry is really starting to suffer, right? I mean, you've seen Amazon lay off a lot of workers. I think Microsoft laid off a lot of workers. You're seeing companies like tech companies across the board laying people off, mass layoffs. And those are the big ones, right? Imagine the smaller ones. So, it kind of became this perfect storm. A lot of it was SVB's making. And when the tech industry started to suffer, if that's, who they provide a lot of banking to, well, they're going to start to suffer. And it may very well have just sealed their fate. So what else caused this, right? Because depending on who you listen to, depending on, if you listen to partisan media, you'll hear some different things, right? You'll hear some people, if you watch more right-wing media, you'll hear people go like, well, the company was woke. They got woke and they went broke. Did that happen? Well, were they kind of woke? I mean, yeah, they were kind of woke. But is that why they went broke? Not really. Now, you did have some Republican lawmakers who tried to say that the bank's diversity, inclusion, and equity program somehow caused this, right? I think Florida Governor Ron DeSantis said it. I believe Marjorie Taylor Greene of Georgia said it. There were a couple others. Can't think of them all off the top of my head, but I know those two are the big ones. I'm sure Donald Trump said something about it. They tried saying that these programs caused it, but there's a spoiler alert, guys. Most banks have those programs. They didn't go under. So it was really poor investments, not D&I programs. Now, on the other side, right, you got the right going, oh, well, the company was woke and they went broke. But not really true. Not really what it was at all. What about regulations? Right, because the left is going, well, it's not that they went woke. That's fine. That's great. It's that we deregulated all the banks, and because they were deregulated, they put themselves in bad situations, and they essentially, placed themselves into oblivion, as if somehow a completely unregulated bank is just going to go, you know what, I don't want to exist anymore, so I'm going to do dumb things. A lot of Democratic lawmakers made noise about the lifting of banking regulations, and that's, what caused it. And if you follow or even listen to some left-wing media, they were pretty vague about it. I mean, you get some saying, well, maybe it had something to do with the stress testing, but most of what I heard really wasn't that. It was very vague stuff. And it kind of turns out both sides are pretty unfounded in their blame game, whether you watch left or right-wing media. I honestly make a good attempt to watch both. Neither one of them really explained what was going on. They never actually got to what caused it. It was just, well, they went woke, or this is why we need more regulations, banking regulations. They were unregulated, and this is what they do. Well, not really. It's ridiculous to the point of being offensive, both of them. So I got into the D&I stuff here. I mentioned the relaxation of banking regulations, but that one actually deserves a little bit more attention. So instead of just getting a third of a slide, it's going to get half of a slide. Now this is, of course, where Elizabeth Warren, Ro Khanna, Bernie Sanders, they're all going to start complaining about the lack of regulation. Right? I can hear it in Elizabeth Warren's extremely shrill voice. What was that? What are they talking about with that? Because, I thought banks were subject to all sorts of regulation, and they had to, submit to the stress tests, and they had to do CCAR and all that stuff. If that's the case, then, shouldn't this have, been under that umbrella? Well, not really. Because in 2018, some banks weren't required to submit to some of these stress tests anymore. The threshold was raised from $50 billion in assets to $250 billion in assets in 2018, as part of the banking deregulation that came out under the Trump administration. A lot of people argued that had the bank been required to conduct these stress tests, do the CCAR scenario analysis, all that stuff, had they done that, then, well, they would still be here today. But I actually worked on the Fed's CCAR scenarios in 2022. That was a hellacious weekend, too. It was one weekend, and you have to run all the scenarios through your models, and God, it was awful. It was so bad. But that's another lecture for another time. But I worked on the CCAR scenario, so I saw what a lot of these scenarios were. I actually fed them through the models that I was running. And it was not at Western Alliance Bank, by the way. Just need to go ahead and make that clear. Just having been a former employee of Western Alliance Bank, I was not there in 2022. I was not running CCAR for Western Alliance Bank. Anyways, moving on. When you look at what the Fed's scenarios were, right, it wasn't what actually materialized in late 2022 and into 2023. The Fed thought the problem would be things like falling GDP. There were an increase in defaults in commercial real estate loans, spike in unemployment. All right, well, none of those things really happened. GDP fell a little bit, but not a ton. kind of, I don't want to say rebounded, but at least GDP growth became positive after 2 consecutive quarters of falling. Defaults in commercial real estate, well, that was pretty modest, actually. We didn't really see too much going on with that. Unemployment's still pretty low. So none of those things happened. So the scenarios the Fed released were wrong. So if the Fed's releasing wrong scenarios, how could the results of the tests based on those scenarios have done anything to indicate how this bank is doing? The best way to say it is it's like going, well, you failed history because I didn't make you take math. They're not the same thing. Right? They're both in school, yeah, but if I don't make you take a math test, it's going to have nothing to do with whether or not you pass a history test. So the stress tests weren't predictive of what the banks were going to face. And it turned out, it wasn't like this risk of default or, risk of like going into a recession. It was actually just interest rate risk. That was the biggest threat to the banking sector. So I'm of the camp personally that the deregulation really had nothing to do with it. Wokeness had nothing to do with it. Deregulation pretty much had nothing to do with it. Because the regulations that they were subject to wouldn't have helped them. It wouldn't have saved them at all. So neither the left nor the right were really correct in what was going on here. It's kind of like, well, there's a story on one side, there's a story on the other, truth is somewhere in the middle. In this case, the truth was like entirely orthogonal to what both of these guys were arguing here. But, of course, Republicans and Democrats had to stick to their guns, and they had to play tribal politics, which, okay, maybe it's fun to follow it sometimes and, play like this like little high school popularity blame game. But when it comes to serious things like a collapse in banks and like the potential collapse of the entire banking sector, probably don't want to politicize that one. Because, well, you get lawmakers who go, well, we're beholden to people giving us money, and we're beholden to our constituents. And if, the news is going on politicizing this stuff, they're going to have to respond. They have every incentive in the world to respond, even if it's to something dumb, and even if it's via doing something really dumb. So you don't really want to politicize any collapse in the banks because it may end up leading to extremely careless, reckless, and irresponsible policy that's not going to fix anything. Right? If it's like, well, all these banks have to submit to the stress testing again. Okay, great. Guess what? If the scenarios for the stress tests aren't in any way reflective of what the economy is going to go through, then how in the hell is that going to help anybody? Honestly, all it's going to do is it's going to take a lot of time and money away from these banks that could otherwise be doing more productive things and go, oh, shit, now we got to do this. And then you're going to take at least a month of their lives away from them when they could be doing something much better. So I think that's enough of the rant here. Yeah, we can move on now. So, long story short, neither the left nor the right were correct in what was happening here. And had these banks been forced to submit to the stress testing, they wouldn't have found the problems anyways. And honestly, actually, rant's not quite done, almost done. At this point, if anybody wants to make the argument that, submitting to the stress testing stuff would have saved them, isn't this kind of just a testament to how extremely ineffective central planners are in general? That the Federal Reserve, that knew they were going to have to be raising interest rates, were like, well, we're going to have a fall, like a reduction in GDP and increased unemployment. It's like, you're going to be raising interest rates in a couple of months. Do you not have any idea that that's what's going to be happening soon? You're the Federal Reserve. You should know these things. That said, now we're done. Now, hilariously enough, right, there's still oversight from the Fed. It's not like there's zero oversight going on here. So we can't even say that nobody saw this coming, because in 2021, the Federal Reserve found a lot of problems with this bank and their risk management procedures. Namely, the models that they were using were complete garbage. the model somehow suggested that rising interest rates would be increasing the bank's interest revenue, and then it would stabilize their financial conditions. And it didn't assume, like, hey, if you have rising interest rates, there will be other adverse effects to the bank that would be affecting your balance sheet. So their models were garbage. They weren't working the way they were supposed to, and Silicon Valley Bank was actually placed under supervisory review in July of 2022 by, you guessed it, the Federal Reserve. So while on one side they're going like, the argument is that the Fed oversight would have saved them, right? The regulation and the stress testing would have saved them. But then even the direct oversight that they were getting from the Federal Reserve didn't save them, because the Federal Reserve was actually worried they wouldn't be able to raise cash if there was a crisis. Okay, so maybe some people at the Fed did see this coming. It's just, well, maybe there could have been a little bit more of a concerted effort. Had the Fed actually wanted to try to stop, or had the Fed, if you wanted the Fed to be able to stop this, you could have handled some things a little differently. Anyways, they saw that SVB may not be able to raise cash if there's a crisis, which would lead to possible exposure to losses as interest rates increased. Gee, would have been nice if you guys had a chief risk officer or something like that. Probably would have helped a little bit. So who was right? Who was wrong? Well, Republican lawmakers wanted to blame DEI stuff, right? Well, that didn't cause it. A lot of banks have it. I'm sorry if there's, I can't conceive of a possible situation where DEI programs regarding individual employee conduct at the bank amongst employees at the bank, how you work and how you treat your other employees, right, your other coworkers. I don't see how programs around that are somehow going to make the bank insolvent. I don't get that one. Democrats wanted to blame, well, the relaxation of the stress test requirements, but stress tests didn't give us scenarios that even remotely came close to materializing, so that didn't do it either. So if DEI stuff and lax regulation didn't cause it, could anything have prevented it? Well, the answer to that is a resounding yes. Good management, a chief risk officer, and better risk models. All those things could have done it. Oh, and, better investment, but I guess we could say that sort of falls under the good management thing. So there are things that could have prevented this. Now, again, are there things that could have prevented depositors from wanting to withdraw additional cash that they had? At the SVB level, no. But there are things SVB could have done to make sure that they could insulate any potential losses much better than they did. But because they were very poorly diversified in their investments, they didn't have a chief risk officer going, hey, you know what? Interest rate risk is starting to become a thing. And their risk models alone were complete garbage. Well, things just kind of went from bad to worse to much, 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 much worse. So to wrap up this almost 50-minute video, Silicon Valley Bank did a lot of dumb things. They were really dumb in a lot of ways. They had poor management, poor risk management. They didn't invest wisely. They didn't have a chief risk officer. But regulation itself wasn't to blame, because the Fed didn't see any of these adverse events happening. So it's not like more regulation would have fixed that, because it's like, well, we want more regulation in this area that's not actually going to do anything to fix your problem. But wokeness didn't cause it either. And regardless of how you feel about either wokeness or banking regulation, the reality of the situation is neither of these two things caused it or could have prevented it. Now, ultimately, the entire banking system was threatened but survived thanks to the resilience of the American banking sector and some of the government intervention when it was needed to try to prevent further runs and an ultimate collapse of the U.S. banking system. But that is that. So now that we know a little bit about what happened with Silicon Valley Bank, I can go ahead and wrap the video up. I hope you enjoyed watching this video, and I will see you all when I see you. Thanks for watching.